As the ETF landscape evolves, how can advisors remain confident in how they trade ETFs across client portfolios? I'm Patrick Hooper. In this video, we'll discuss what good ETF execution looks like, how ETFs behave during market stress, and what advisors should know as the ETF universe continues to expand. As the ETF universe continues to expand, trading considerations are becoming increasingly important for advisors when implementing investment strategies. One of the key advantages to ETFs is their ability to offer two unique layers of liquidity. The secondary market liquidity, where ETF shares are bought and sold, often on exchanges, and the primary market liquidity, where ETF shares can be created and redeemed by authorized participants. For smaller trades, advisors can typically rely on the secondary market liquidity, placing limit orders or marketable limit orders to execute their trades. However, for larger or more complex trades, accessing the primary market liquidity becomes essential to ensuring efficient executions. Using the right trading strategy to tap into both layers of ETF liquidity becomes essential to help achieve best execution. This is where the ETF Capital Markets Desk plays a pivotal role. We partner with advisors to navigate these trading decisions, helping them optimize their access to liquidity while reducing their trading costs. Our goal is to ensure that every ETF trade is executed with precision, aligned with the investor's strategy to minimize transaction costs across their portfolios. During periods of market stress, trading best practices become even more critical, as heightened volatility can lead to wider ETF spreads and increased trading costs for investors. Achieving good execution is straightforward in principle. It means executing trades with minimal market impact, or in other terms, minimal ETF price impact. For smaller trades, this typically involves executing the trade within the quoted spread at the time of the trade. For larger ETF trades, it means executing the trade with minimal price impact on the ETF that's in line with the fair value of the ETF's underlying securities. To help advisors achieve best execution, several best trading practices should be considered. First, use limit orders or marketable limit orders to avoid unexpected price outcomes. Second, avoid trading during the first 15 to 30 minutes after the market opens. This is when spreads tend to be wider due to price discovery in the market. Third, steer clear of the opening and closing auctions, which can carry higher risk of trading the ETF at heightened premiums or discounts. Fourth, for large ETF trades, consider consulting your custodian's block desk to align order types that will help reduce price impact. And lastly, engage with the ETF Capital Markets Desk. We can help tailor a trading strategy that maximizes your ability to access liquidity and minimizes transaction costs for both you and your clients. Periods of extreme market volatility, such as March 2020 and April of this year amid the tariff uncertainty, highlight the reliability and the efficiency of ETFs as an investment vehicle. Volatility naturally leads to wider market spreads due to pricing uncertainty, and advisors should be cautious trading ETFs during these times. With that being said, Vanguard ETFs have consistently demonstrated their resilience during times of market turmoil. Vanguard ETF spreads remain significantly tighter than those of the underlying securities within their portfolios, as reflected in their basket spreads. ETFs also serve as effective shock absorbers during market stress. Roughly 80 to 90% of ETF trading volume occurs in the secondary market, where shares simply change hand between buyers and sellers without triggering trading activity in the underlying securities. This structure helps contain volatility and reduce disruption in the broader market. Only a small fraction of ETF volume flows through to the primary market, limiting the need for in-kind creations or redemptions, preserving liquidity in the underlying assets. This dynamic reinforces the value of ETFs, not only as an investment tool, but as a stabilizing force during turbulent market conditions. When economic news is released intraday, ETF spreads tend to widen in anticipation of the announcement due to increased pricing uncertainty. Key economic releases often occur at 10 a.m. Eastern Time, while federal rate decisions are typically released at 2 p.m. Eastern Time. These moments can lead to heightened transaction costs for advisors trading during or around these release windows. When the Fed announced in September its decision to reduce rates by 25 basis points, ETF spreads widened across the market and remained elevated through market close. To help mitigate these risks, advisors should consider the following best practices. Avoid trading during known economic news release windows if possible. And if trading is necessary, reset expectations and consider using a limit order or marketable limit order to prevent unintended execution outcomes. Being aware of the timing and impact of economic news is essential to achieving best execution. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.